Welcome to ForexTV.com's New York Forex Market Buzz. It's Wednesday, June 3rd. I'm Julie Sinha. Today we are broadcasting live from the Profit and Loss Forex Network in downtown Manhattan. Joining me today is M3 Capital's president, John Netto. Hi, John.
Julie, great to be here.
It's great to have you back. And now we're at a conference, so we're right in the middle of the action today.
One of the multitude of venues we share our opine on the market direction.
And thanks for joining us. I know you just came off from another panel that you moderated, so we'll keep it going right now.
It's been a great conference. We've touched on some important issues in the wake of the 2008 financial fallout and in early 2009. We've touched on some of the technological components at play here in the market, structural components, and just the process that allocators and investors are going through when looking to base their investment decisions. So far it's been a great conference. I'm looking forward to the rest of the day.
Yeah, I guess you haven't been able to be in front of all the monitors and in the middle of trading, but let's talk about what happened this morning. We saw stocks fell. The U.S. jobs data came out. It beat expectations, but it still showed continued loss, still above that 500,000 psychological level. We saw the U.S. dollar come back from a lot of losses that it suffered. What's your thought on market sentiment now, how Forex traders are reacting to this and Bernanke's comments?
I think you touched on something very important, that's market sentiment, and that we've been on before, and one thing I focus on in my trading style is what is the sentiment of the market. If it's technically bullish and fundamentally bullish, then you often find the markets will buy weakness or use big spots or big sell downs to come in and create or aggregate long positions. Conversely, when the opposite is the case, we'll find that more selling ensues. Well, even with the jobs data that came in this morning the way it did, the sentiment of the market to me is starting to shift, and I think traders are picking up on that. We've seen a compression of volatility. There's a lot less risk aversion and much greater risk appetite out there. We've seen this reflected in both emerging market currencies, emerging market equity markets, small caps. European markets have outperformed U.S. markets, and across the risk appetite spectrum, the last 3 months has been a very fruitful and profitable time for those who've taken a more aggressive opinion in terms of their risk appetite. And I think that pendulum is starting to switch over, and a way of identifying that is seeing when good news comes out or what should be perceived as good news is sold into. And when that pattern starts to persist again, it's maybe awakening that the longer-term structural bear market that's in place may be reemerging.
And what you just touched on, actually, Bernanke had reiterated that the pace of economic contraction appears to be slowing, setting the stage for return of growth later this year. Do you think that this is really, new news or a new opinion that the market's airing, or this is something that, was expected?
I'm not sure how digestible that comment is and how much the market believes it, but even if that is the case, look at the 40 or 45% rally we've had across a number of markets, and so that's almost like buying the rumor and then selling the news when it actually comes out. So if you do believe what Bernanke said, then the price action of the last 3 months then encapsulates that.
Yes.
But in terms of what that means going forward, I think that's where the trepidation and concern lies.
Yes, and we saw equities pull back slightly. They've been rallying for 4 sessions in a row.
Right.
They pulled back on the news from this morning. The dollar recovered a bit.
Sure.
Do you think that this is going to be short term and that we'll continue to see dollar weakness continue in the longer term?
I think longer term the markets are falling out or carving out a top in terms of the equity markets and setting up for a deeper pullback. I think in case of the currency markets, we're going to begin to see a decoupling of what the currencies represent. They're going to take on more fundamental or company-specific dynamics and much less risk appetite, risk aversion dynamics. And we've seen that with the euro and the U.S. dollar. The euro and the British pound have really overlaid much of that equity rally. Recently, we've seen gold pop up again. I think we'll see gold actually decouple and break away and rally on the notion that there's a lot of concern over fiat currency in the world out there. And we've seen the price in silver. Silver hit over $60 an ounce. Gold up near 980, and while those may succumb to short-term weakness, I think that this next pullback, if we do get a pullback in the equity markets, gold and silver and the precious metals will not be as badly affected as they have in the past when the equity markets have sold off.
And what do you think that means for commodity-linked currencies? I mean, we're recently been seeing Aussie, the Kiwi, CAD coming up stronger, even though Canadian dollar did lose a little bit earlier against the U.S. dollar. What are your thoughts about those commodity-linked, higher-yielding currencies?
Well, I think the commodity-linked currencies will actually not necessarily replicate the price of gold and silver in the sense of the commodity play has been on a reinflation or restabilization of growth out there. And when that growth dynamic comes into question, that doesn't necessarily mean that gold and silver will sell off, although they may, as they have in the past. But I think that those currencies would be more prone or subject, like maybe the Aussie-yen cross right there would become more vulnerable just because of the risk-averse risk appetite dynamic that's inherent in that currency cross right there. But overall, I think the commodity currencies would sell off because, especially the sentiment that's driving the sell-off, entails to questions or doubts over future growth prospects for the world in general.
And what about the confidence in those regions? About Australia, we saw expanding unexpected growth in the earlier quarter, and then New Zealand. What about the economic conditions there? I mean, they look pretty favorable, but what does that mean for the currencies?
Again, it comes back to sentiment. It's not so much
sentiment today. Keyword today.
Sentiment every day. if the sentiment is bullish in the market, I want to be working the bids. If it's bearish, I want to be working the offers. And I hate to compartmentalize my approach to one key sense, but that's ultimately what it comes down to. And so, even if the growth prospects look good for the Aussie, we've still put in a meaningful rally in that Aussie Yen cross and in the Aussie Euro cross as well. Or Euro Aussie cross, and so I think that sentiment right now following this rally has gotten a bit euphoric, and so we're vulnerable to a pullback or susceptible to a pullback. And what that, especially if you look at implied volatility and even realized volatility across a number of these currency components as well. It was implied volatility or even realized volatility was great in October, November. December started to fade or wane a little bit. It picked up again in February and March with this pop. But it's become more and more compressed. That compressed volatility or that shrinking volatility is normally associated with greater degrees of complacency. And because there is that overlay, because there is that relationship between the commodity currencies and the equity markets, lower implied volatility readings mean that the equity markets are more susceptible to a pullback, also means the commodity-linked currencies are more susceptible to a pullback as well.
Let's talk about that correlation you just mentioned between commodities and equities. Now, what about that carrying over to the currency marketplace? I mean, what do you expect? Do you also expect that market correlation between equities and currencies inversely to be as strong as we've seen with the U.S. dollar?
Longer term, I think, like I talked about, there'll be more of a decoupling. Like if you want to look at some emerging market plays, like if the true component of the global growth comes into question, there'll be some currencies that are hurt more than others. I think the Mexican peso can be hurt. I think some of the some of the look in South America and in some parts of Europe as well. But I think that we'll see going forward the next 6 months, 7 months, 8 months, more of a dynamic of country-specific dynamics that drive those currencies.
Okay, John, we're just about out of time. Thank you for being here with us.
Julie, it's a pleasure being with you too.
That does it for our New York Forex Market Buzz. I'm Julie Sinha with John Netto, president of M3 Capital, and we just discussed what's going on in the Forex markets now and the reaction from global markets after that U.S. jobs report. If you want to connect with John Netto and other ForexTV commentators, please go to www.forextvconnect.com to see what his opinions are on the market.